Welcome to today's deep dive. Whether you're catching up on some complex financial mechanics or you're just, insanely curious about how money actually moves when the training wheels come off, you are definitely in the right place.
Hmm.
Today's mission is unpacking this really intriguing excerpt we have titled The Mechanics of High-Risk Speculative Investing. And I want to promise you right now, we're going to break down these complex mechanics without all the impenetrable jargon.
Right, because the underlying concepts are actually pretty intuitive once you
Right.
strip away the finance speak. What's fascinating here is just looking at the fundamental difference outlined right at the start of the source. It draws this stark line between traditional investing and speculative investing.
Yeah, traditional investing being the classic buy and hold strategy. You acquire an asset, you hold it for years, and you rely on long-term macroeconomic growth.
Exactly. You assume time is going to smooth out your risk. But speculation fundamentally rejects that timeline. A speculator is hoping to profit from rapid changes in asset value. They aren't waiting for a decade of growth.
They're active.
Very active. They're taking on high risk because the frequent price movements can be highly rewarding.
Mm.
And counterintuitively, the source points out that this can actually provide portfolio diversification.
Which sounds a bit wild, right? Like injecting high volatility to balance things out. But it's because it's a totally different mechanic, which brings us to the core philosophy of the swing.
The philosophy of the swing, right?
Yeah, to deconstruct the speculation, think of it like an analogy. Rather than planting a tree and waiting 20 years for it to bear fruit, speculators are actively trying to catch lightning in a bottle. They want to take advantage of short-term volatility.
They need it. The ultimate goal, as the text emphasizes, is trying to profit from a, quote, large market swing. And that requires a completely different mindset from the buy and hold crowd. Traditional allocators see short-term volatility as noise to be ignored. Speculators see it as the absolute prerequisite.
Right, if an asset's price stays perfectly flat,
They starve. There's no gap to exploit. They require the turbulence, which sets us up perfectly to look at the three specific examples provided in our source material.
okay, let's unpack this with the first arena, the bond market. Specifically, how U.S. Treasuries are often strongly influenced by speculation. Usually, bonds are seen as the sleepy, safe part of a portfolio.
Well, sleeping until the macro factors shift. The mechanics affecting the bond market are heavily driven by the direction of interest rates and broader macroeconomic triggers. When a central bank signals a change, bond prices react violently.
Because there's that inverse relationship.
Right, so speculators aren't just sitting back clipping coupons, they are aggressively trading the fluctuating price of the bond itself.
And the research makes a really important distinction here regarding ratings and risk.
Mm.
Highly rated bonds, your investment grade stuff, that is not speculative. But the lower rated bonds absolutely are.
This is the junk trade-off.
Yeah. Exactly, the junk bonds. And for you listening, this is where the mechanics get really stark. Because these lower rated speculative bonds carry a significantly higher risk of default, they compensate the investor by paying out much higher interest rates.
The market is mathematically quantifying the danger. The higher yield isn't just a perk, it's the premium you demand for taking on the probability that the company might go under.
It's just wild to me, marveling at that direct, almost brutal relationship between risk and reward. You are actively stepping into market distress and demanding a massive premium for your liquidity.
It's a ruthless calculus, but it's pure mechanics.
So, shifting gears from credit markets, let's pivot to the second example in our text, precious metals. Specifically, we're talking about gold and silver.
The classic safe havens, or so the myth goes.
Right. People think of gold as this static, perfectly safe store of value, but the text categorizes them definitively as speculative because they fluctuate in price constantly.
Constantly. The assertion here is that precious metals experience both short-term and long-term price volatility. Their pricing is caught in this massive tug of war involving real interest rates, the U.S. dollar, geopolitical events.
And because they don't produce a yield, right? Like a gold bar doesn't pay a dividend.
Exactly. So its entire value is just dictated by what someone else is willing to pay for it at any given second, which means tangible volatility.
And we need to highlight the reality check the source provides here because it really grounds the concept for you. The value of these metals depends entirely on market conditions. If you are forced to sell in a declining market, the price you receive may be less than your original investment.
That is the ultimate cautionary tale of playing with volatile speculative assets. The physical, tangible nature of the gold doesn't protect you from a liquidity mismatch. If you need capital on a Tuesday and gold happens to be dumping on that exact Tuesday, you take the loss.
The market doesn't care what you paid for it 6 months ago.
It only cares about the spot price right now.
It's a brutal reality. But that transition from physical assets leads us to the third example, and here's where it gets really interesting.
Oh, yeah.
Foreign currencies. Forex trading. The fundamental mechanic outlined in the source is that it involves buying and selling currency pairs.
It's a purely abstract market. You aren't evaluating the euro in a vacuum. You're trading a pair. So you're evaluating the euro against the US dollar.
Right. It's a literal seesaw mechanic.
Exactly. As the value of one currency goes down, the other inherently goes up. It's a zero-sum relationship. So traders are obsessively speculating on which way this relationship will swing to profit off the change.
But the actual movements between currencies on a daily basis are tiny, right? So how does the profit happen?
Through extreme leverage. Because the daily swings are so small, brokers offer massive leverage so speculators can magnify those fractional movements into significant gains.
Which, of course, magnifies the risk to an insane degree. But there is a unique feature of Forex that makes it so wildly popular with speculative investors, and that's the schedule. The markets are open 24 hours a day.
It's decentralized. Continuous uptime.
Which sounds great. You can trade whenever. But we really need to shift the tone here because the text issues a crucial warning about the dark side of this 24/7 environment.
Yeah, the Commodity Futures Trading Commission, the CFTC, have been very explicit about this.
We have to impartially report what the documentation outlines. A variety of recent scams have hinged around fraudsters approaching potential marks in the Forex space. According to the CFTC, these fraudsters typically offer fake investments or proprietary coaching in Forex trading.
They use the intimidating complexity of global macroeconomics as a smokescreen. They approach retail participants and promise guaranteed returns or pretend they've solved the market with some secret algorithm.
But guaranteed returns in a zero-sum, highly leveraged 24-hour market are mathematically impossible.
Right. Professional speculators with billions in capital lose money in this market. The fraud relies entirely on the mark, not understanding the fundamental mechanics we just talked about.
It's so important to remind you listening of the vital importance of critical thinking here. Navigating high-risk spaces means understanding that the risk isn't just a byproduct, it is the instrument itself.
You can't separate the mechanics of speculative investing from the predators it attracts.
Exactly. So let's pause and synthesize this. What does this all mean for you? We've summarized these three avenues: junk bonds, precious metals, and Forex. And understanding them gives you a much clearer lens through which to view financial news.
It completely reframes how you process information. When you see a headline about a currency flash crash or bond yields blowing up, you realize it reveals how some investors actively seek out the very volatility that others try to avoid.
What's a crisis for a traditional buy-and-hold investor is the exact required fuel for a speculator.
They need the swing.
They need the swing.
Well, I want to thank you for joining this deep dive into the mechanics of high-risk speculative investing. I really hope it provided some valuable aha moments and stripped away some of the jargon for you.
And before we wrap, there is one final provocative thought that builds on these themes of time and volatility. Something for you to just mull over.
Go for it.
Since speculative investing relies so heavily on taking advantage of short-term volatility, and we know markets like Forex operate 24 hours a day, as global markets become increasingly intertwined and react faster and faster to macroeconomic factors, does the very definition of short-term keep getting shorter?
Wow.
Right? Does it fundamentally change the nature of how a speculator has to operate?
Does short-term eventually just compress into the instantaneous? That is an incredible question to leave on. Thank you again for listening. Keep questioning the mechanics, keep exploring, and we'll catch you next time.